Something just happened in the silver market that has not been seen since the summer of 2008. And if you know the history, you know that what came next was one of the most violent, most traumatic financial events of the last 100 years. I want to walk you through exactly what that signal is, why it matters, what happened the last time we saw it, and most importantly, what it means for your money right now. Stay with me, because this is one of those moments where understanding the pattern before the crowd does is the difference between getting crushed and coming out the other side intact. Let me take you back to a specific morning in the spring of 2008. A veteran trader on the floor of the New York Mercantile Exchange, a guy who had been trading silver futures since the early 1990s, looked at his screen and felt something cold move through his chest. Not panic, not excitement, something quieter and more dangerous than either of those things. Recognition. He had seen this setup before, not in his trading career, but in the charts, in the books, in the data going back decades. The specific configuration of price action, volume, and what was happening in the credit markets at the exact same time told him something that almost nobody else was paying attention to yet. He started making phone calls. He repositioned. He protected himself and several of his clients. And then, 6 months later, the financial world burned down around everyone who hadn't seen what he saw. I'm not here to scare you. I'm here to show you the same thing he saw, except now we're looking at it happening again, right now, in silver. Silver is currently sitting at around $70 an ounce. That sounds like a big number if you've been watching this market for a long time, and in some ways it is. Silver had a remarkable run getting here. But here's the thing about silver that most people who talk about it on the internet completely miss. Silver is not just a precious metal. It's not just gold's little sibling. It's one of the most industrially critical commodities on the planet. More than half of all silver consumed every single year is consumed by industry, by solar panel manufacturers, by electric vehicle battery producers, by semiconductor fabricators, by the medical equipment industry, by the defense sector. Silver conducts electricity better than any other metal. It cannot be substituted away. So when silver starts flashing distress signals, you're not just looking at a metals market anomaly. You're looking at a warning light on the dashboard of the entire global economy. Now, let me tell you exactly what the 2008 signal was and why what's happening right now is its mirror image. In the months leading up to the 2008 collapse, several things were happening simultaneously. The first was a massive buildup in the commercial short position on silver at the COMEX, the commodity exchange in New York, where silver futures are traded. The commercial traders, which in the silver market primarily means a handful of the world's largest banks, were building historically extreme short positions. In plain English, they were placing enormous bets that silver's price would fall. Now, on the surface, you might say, well, banks are smart, maybe they just knew something. And here's where it gets fascinating and disturbing at the same time. Because those banks, building those short positions in 2008, were simultaneously sitting on mountains of toxic mortgage debt. They were bleeding internally. They needed the broader commodity market to behave in a certain way to manage their exposure. So those short positions weren't just trades. They were survival mechanisms for institutions that were quietly drowning. The second thing that happened in 2008 was the gold to silver ratio began to behave very strangely. The ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back centuries, that ratio has averaged somewhere around 15 to 1 in nature, meaning for every ounce of gold in the ground, there are roughly 15 ounces of silver. But the financial market ratio floats. It compresses when silver is outperforming, and it expands when fear is rising and money is fleeing into gold specifically. In the months before the 2008 crash, the ratio was starting to widen out in ways that, in hindsight, were screaming a very specific message about where the financial stress was building. We are seeing structurally similar behavior in that ratio right now. And when you layer in what's happening in the broader credit markets, in global debt levels, in the behavior of institutional money flows, the pattern becomes almost uncomfortably familiar. The third element of the 2008 signal was what was happening in the physical silver market underneath the paper market. There's a world that most retail investors never see, the world of allocated silver, the world of physical delivery demands at COMEX, the world of premiums between what physical silver actually costs versus what the futures price says it should cost. In 2008, those premiums were starting to diverge. The paper market and the physical market were beginning to tell two different stories. That divergence is one of the most reliable warning signs that something is structurally wrong, because it means the financial abstractions built on top of real metal are starting to crack. And right now, if you know where to look, you can see cracks forming again. Let me talk about what actually happened when the 2008 signal completed, because this is critical context, and it's also the part that most people get wrong when they tell the story. When Lehman Brothers collapsed in September of 2008, silver didn't just hold its value, it crashed hard. Within weeks, silver went from around $18 an ounce down to roughly $8.40. That's a collapse of more than 50% in a matter of weeks. And here's the question you're probably asking right now. If silver is a safe haven, why did it crash during the financial crisis? This is the part that very few people understand, and understanding it is everything. When a financial crisis hits, a real one, not just a stock market correction, but a genuine systemic credit crisis, the first thing that happens is institutions, hedge funds, and big money players start getting margin calls. When you're getting margin calls, you sell whatever you can sell. You don't sell what you want to sell. You sell what has a liquid market. And silver has an extremely liquid market. So silver, gold, and every other commodity that had been running up in the years before 2008 got liquidated en masse to cover losses in the mortgage market, in equities, in structured credit. It wasn't a reflection of silver's fundamental value. It was a forced liquidation event. But here's what happened next, and this is the part that changed lives, for better or worse, depending on which side of the trade you were on. After that brutal crash in late 2008, silver began one of the most spectacular recoveries in commodity market history. From that low of $8.40, silver climbed steadily, then rapidly, then almost violently, all the way to $49.50 in April of 2011. That's a gain of roughly 490% in about 2.5 years from the low. The people who understood what had happened, who understood that the crash was a forced liquidation, not a fundamental collapse in silver's value, and who bought during that moment of maximum fear, were handsomely rewarded. The people who panicked and sold at the bottom, or who had been completely in the dark about what was happening, suffered one of the most preventable wealth destructions imaginable. Now, I want to be very precise about something. I am not predicting that we're about to see silver crash 50% next month. The signal I'm describing today is a pre-crash signal, meaning it preceded the 2008 event. The crash itself was triggered by a specific event, the collapse of Lehman Brothers, which was the moment the financial system froze. What the signal tells us is not that a crash is happening tomorrow. What it tells us is that the conditions that produced the 2008 event, the structural stresses, the leverage, the divergences, the vulnerabilities, are present again right now. In some ways, they are more extreme than they were in 2008. Think about what the world's financial system actually looks like right now. Global debt has expanded to levels that would have been considered absolutely science fiction to an economist in 2008. The United States alone carries a national debt load that is structurally different from anything that came before it. Central banks around the world have used every tool available to them, and invented new tools when the old ones weren't enough, to keep an increasingly fragile system from tipping over. Interest rates were held near zero for years, and the consequence of that was the creation of asset bubbles across equities, real estate, and credit that make the 2008 housing bubble look almost modest by comparison. Here's where it gets important for your personal financial situation, and this is where I want you to really pay attention. Quick pause for a second. If you're watching this and you have $100,000 or more in a retirement account, I put together a free guide that walks through the saving strategies thousands of American retirees are using right now to protect their hard-earned wealth from exactly what we're talking about. It's in the description below. Worth checking out if you're concerned about what's coming. Now back to the analysis, because I want to show you something about the current silver market that goes beyond the 2008 pattern. The silver market has been running what the Silver Institute, the industry's own research body, describes as a structural supply deficit. That means more silver is being consumed every year than is being mined and recycled to replace it. This is not a minor imbalance. This has been happening for multiple consecutive years now. Global solar installations have exploded. Electric vehicle production continues to accelerate. The electronics and semiconductor industries show no sign of reducing their silver intensity. All of this is happening at a time when new major silver mine discoveries are vanishingly rare, and the lead time to bring a new mine from discovery to production is measured in years, not months. Now, layer on top of that the geopolitical dimension, because this is where the 2008 parallel gets even more eerie. In 2008, the financial crisis was primarily a Western, dollar centric event. The system that broke was the dollar denominated financial system. The mortgage backed securities, the credit default swaps, the leveraged buyout debt that had been packaged and repackaged and sold around the world in instruments so complex that even the people selling them didn't fully understand what was inside them. When that broke, it broke inside the dollar system, which is why when people fled to safety, they fled to dollar denominated assets, including US Treasury bonds, ironically enough. The situation today is fundamentally different in one critical way. The dollar system itself is now the thing that a significant portion of the world is trying to reduce its exposure to. The BRICS nations, Brazil, Russia, India, China, South Africa, and the expanding membership beyond those original five, have been explicitly, deliberately, and systematically reducing their dollar reserves and their dependence on dollar-denominated trade. Central banks around the world, for 4 consecutive years running, have been buying gold at a pace not seen since the 1960s. That's not a coincidence. That's a coordinated, strategic repositioning away from the US dollar as the singular foundation of global trade and reserves. And silver sits in a fascinating, complicated, and potentially explosive position inside all of this, because silver is gold's industrial twin. It's both a monetary metal and a critical industrial input, which means it benefits from 2 completely different sets of demand drivers simultaneously. The monetary and geopolitical demand that's driving gold higher also has a gravitational pull on silver. But silver also gets the industrial demand tailwind that gold doesn't have, because nobody is using gold in solar panels or electric vehicle motors. Let me walk you through one more historical parallel that very few people are drawing right now, because it's the most important one. Before the great bull market in silver that ended in 1980, when silver touched $50 for the first time in history during the Hunt Brothers episode, there was a period in the early to mid 1970s that looked remarkably similar to where we are today. The dollar had just been severed from gold by President Nixon in 1971. The world was adjusting to a new monetary reality. Inflation was building, oil prices were exploding, the geopolitical order was in visible flux. The Cold War was at a different stage, the Middle East was in upheaval, and the established frameworks for how nations interacted economically were being challenged in fundamental ways. Silver in the early 1970s was still under $2 an ounce. By 1980, it had hit $50. That's a move of more than 2,500%. I'm not predicting a 2,500% move. I'm not predicting any specific number. What I am pointing out is that when the monetary order fractures, when the foundational assumptions about how wealth is stored and transferred break down, silver has historically been one of the primary beneficiaries. And the fracturing of the monetary order is not a fringe prediction right now. It's being discussed in the finance ministries of major nations. It's embedded in the reserve diversification decisions of central banks on 6 continents. It's happening in slow motion, right in front of us. Now I want to talk about something more personal, because ultimately, what matters isn't the historical parallels or the geopolitical analysis. What matters is what this means for you. There's a specific group of people who are most exposed to what's coming, and it's not who most people think. It's not the reckless speculators. It's not the people who've been taking wild risks. It's the responsible, hard-working Americans who did exactly what they were told, who built up their retirement savings over decades, who put money into their 401ks and IRAs faithfully, month after month, year after year, who own homes, who have diversified broadly within the conventional system. These are the people who are most exposed to a dollar system under structural stress, because their entire financial life is denominated in dollars and dollar-denominated assets. Their stocks, their bonds, their pension, their social security checks, all of it priced in the same currency that is the subject of a slow-motion global exit. The average American retiree has done nothing wrong. They played by the rules, they saved, they were prudent, and the rules are changing around them in ways that they weren't told about, weren't prepared for, and in many cases don't yet fully understand. This is exactly why the institutions that actually understand monetary history, the central banks, the sovereign wealth funds, the multi-generational family offices that have navigated multiple monetary regime changes, have been building their physical precious metals exposure systematically. Not dramatically, not in a panic, but with the quiet, methodical patience of people who understand that when the music stops, physical assets are what matters. Now, there's a way for individual investors, for people who've built up retirement savings, to access the same kind of physical gold and silver exposure that the big institutions have been quietly accumulating. It's called a gold IRA. And I want to spend just a moment on this because I think it's genuinely relevant to what we're discussing today. A gold IRA allows you to hold physical precious metals, actual gold, actual silver, actual tangible assets inside a tax-advantaged retirement account. Not paper gold, not an ETF that represents a claim on gold. Physical, allocated, real metal held in a secure vault on your behalf. The rules around how to do this properly are specific, and there are ways to do it that preserve your tax advantages and ways that accidentally trigger penalties if you don't follow the process correctly. But for someone sitting on a meaningful amount in retirement savings who is genuinely concerned about what a dollar system under stress looks like for their financial future, this is a tool worth understanding. If any of that resonates with your situation, I've put together information in the description about how this works. Back to silver. The thing that makes the current moment particularly interesting, and let me be honest, intellectually fascinating in a way that doesn't diminish the seriousness of the stakes, is the compression that's been building in the gold to silver ratio. Right now, that ratio tells us that silver is historically undervalued relative to gold. The last several times this ratio was at these levels and then began to compress, meaning silver started to outperform gold, what followed was a significant move in silver, not just a percentage point or two. We're talking about silver catching up to gold's performance in a way that produces outsized returns for people holding silver versus gold. The mining economics make this even more compelling. When you look at the actual cost structure of primary silver miners, the companies whose revenues depend primarily on silver prices, a significant portion of the silver supply being produced right now is being produced at or near the cost of production. That means the buffer between current prices and the price at which production starts to get cut is not enormous. If demand accelerates, and the industrial demand case alone makes that nearly certain over the next decade, and production simultaneously gets constrained by the economics of marginal mines going offline, you have a classic supply shock setup building in slow motion. The paper market and the physical market are telling different stories. Not dramatically different yet, but the divergence is there for those who know how to read it. The lease rates, the interest rate at which physical silver can be borrowed, have been showing signs of stress that don't show up in the headline spot price. The forward price structure has been shifting in ways consistent with tightening physical availability. The premium that dealers charge over spot for physical coins and bars has been quietly widening. None of these signals is individually alarming. Together, they form a pattern. The question isn't whether silver's fundamental case is strong. It is. The question is the timing and the pathway, and specifically, whether we're heading into another forced liquidation event similar to 2008 before the fundamental case plays out. If we are, and the signal we opened this video with suggests we might be, then the playbook is actually quite clear for people who've thought about it in advance. You want to have positioned yourself before the potential liquidation event, not after it. You want to be the person who bought at $8.40, not the person who sold at $8.40 in a panic. The most important thing I want to leave you with is this. The 2008 financial crisis didn't destroy wealth uniformly. It destroyed wealth for the people who were unprepared and concentrated in the wrong assets at the wrong time. And it transferred wealth, massively, to the people who understood what was happening, who had positioned defensively, and who had the psychological and financial fortitude to hold through the liquidation event to the other side. That transfer of wealth was one of the largest in modern economic history. And based on everything the data is showing right now, the signals, the patterns, the structural vulnerabilities, the geopolitical realignment, the supply deficits, the monetary system stress, there is a reasonable argument that we are in the early stages of another such transfer. Whether you're on the winning side or the losing side of that transfer depends entirely on what you know and what you do with what you know, right now, before the signal completes. I'll leave you with this. That trader on the COMEX floor in 2008 who recognized the pattern, he didn't have special access to insider information. He wasn't a genius. He was a student of market history who had done the work to understand what these signals actually meant when they appeared in the data. The information was available to anyone. Most people just weren't looking. They were looking at their 401k statements and their real estate valuations and the headlines telling them everything was fine, right up until it wasn't. you're looking now. That already puts you in a different category. If you made it to the end of this video, and I mean really made it, not just skimmed through, I have something specifically for you. The free guide in the description gives you a breakdown of the saving strategies that thousands of American retirees are using right now to protect their wealth. But for people who watched this all the way through and have $100,000 or more in any retirement account, IRA, 401k, pension, any retirement vehicle, if you mention that you watched to the end when you reach out, you'll get access to an exclusive one-on-one educational web conference, completely free, no obligation. It's not a sales call. It's a genuine educational session, one-on-one, walking through exactly how to evaluate your current exposure and what your options are. It's only available to American retirees who meet that threshold, and it's only available to people who were paying close enough attention to make it this far. The signal is flashing. Whether you act on it is up to you.